and it's better to pay for a good property manager. Not any old property manager, not a real estate agent. Potentially, it can be a waste of money, but a good property manager worth the weight in gold.
So it's the methodology that we use for our buyer's agency that we also provide in our suburb selection for our buyer's information pack.
Council rates, water rates, your insurances, landlord, building insurances. I think the one that arguably is hidden, and even some investors don't see it after investing for many years, is the cost of wear and tear that can happen on your property.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
Today, we're going into some of the questions getting asked on the Perth Property Investment Facebook group. And if you're not already a part of the conversations, head over to Facebook, search Perth Property Investment and request to join. It'd be great to have you involved in the combos and sharing any questions that you have. So let's dive into some of our questions that we've got. I've got Dwayne Long, who's our superstar property manager / business development manager at Investors Edge. Thanks for joining us today, Dwayne.
You're very welcome, Jared. Glad to be here.
You haven't been on the show in a while, but I thought it'd be good to get your take on some of these things because you're an investor yourself and you've got a very wide perspective on what we do in buyer's agency sale and property management. And you probably get a lot of these questions from clients every day as well.
Yeah, some of them, definitely.
Some of the questions go to me, but between us, I think we'll be able to tackle them. So keep in mind, everyone, this is just our opinions and 2 cents worth. And we don't know your specific situation, but we'll try to give some general input. And even if you're not in this situation now, maybe later when you are, you can put this in the back of your memory bank and hopefully have a head start when it comes to next thinking on these topics. So, first question, Dwayne, do you want to read it out?
Morning, all. I am looking for some potential suburbs in Perth for investment purposes, preferably new houses, and zeroed in on Baldivis within the city of Rockingham. Can you please share your feedback on this suburb? You can go first, Jared.
I don't know why every East Coast investor, not every, but I exaggerate there, but a lot of East Coast investors seem to be so, focused on Baldivis. Like, they obviously haven't had the history that we have and seen what's happened to Baldivis in the worst of markets here in Perth. And I like to, not just be investing for today, but think back and to when things weren't as hot in the market. And Baldivis is one of those suburbs that, our property managers really struggled to find tenants. The rental prices dropped massively. There was a big oversupply of properties for rent and for sale. The sale prices dropped drastically. And you look at the aerial image and what future stages are planned for the suburb, and there's land coming on for decades down there. It's amazing what they've built in terms of a community. It's already a very massive suburb, one of the biggest suburbs in Perth. But all of those things, you have to ask, how are you doing your research to find what's going to make a good suburb for growth and rentability? Do you want to take us through some of your thinkings on Baldivis and what you potentially look for in a suburb that's going to make a good investment for those reasons?
Well, I think you hit the nail on the head with Baldivis having quite a lot of land around it, that hasn't necessarily been developed and sold yet. So supply is not really going to be restricted, and therefore I feel prices may not grow as quickly as those tightly held low supply areas. Having said that, though, building costs are still very, very high. So new stock may not appear for a while. So in the short term might look quite attractive, but long term, who knows?
I think people often get attracted to, the shininess of the properties. They are relatively new when you compare Baldivis to some of the more coastal suburbs. But when you're at least directly on the coast, and I heard someone in a different forum saying Baldivis was close to the beach and close to the freeway, but for us in Perth, close to the beach is directly beachside, usually. It's the suburb that directly fronts the water. So for me, those suburbs, and we're talking Port Kennedy, Warnbro, Rockingham, Shoalwater, Waikiki, they have gone through, when we look at the newer suburbs like Warnbro and Port Kennedy, a lot of the houses there were built 20 years ago. And then when we look at Rockingham, Shoalwater, Waikiki, a lot of the houses there were built sort of 40, 50 years ago. So those areas are a lot more built out now. There's very little land that's going to come on. In Port Kennedy, there's a new sort of release of directly releasing sort of a bit of a marina and an estate directly on the beach. But I think that's going to add to the area overall and not actually detract from the existing house stock. And it's only going to make it even more built out. And so there's also a fair bit of reserves around areas that won't get built on around Port Kennedy. So you need to look deeper, not just at total land that is there, but what's the intended use for it. And I personally would rather be, if I'm putting my money in down there, we have bought a few properties for clients that are on those direct beach front suburbs, and the government's throwing a huge amount of money into our defence off of Rockingham area there and all the supporting industries that support the defence spend for the submarines. So that will continue to boost the area for jobs and add extra, demand from workers and stuff that are going to be supported there. So it's actually not a bad area to be looking at for investment. And I expect the future decades are going to all be better than the past decades, especially for those directly coastal suburbs where the land supply is now, mostly bought out. But I'd certainly be, if you're spending $600K to get into Baldivis, why not spend the same to get into a directly coastal suburb and have better chances for growth?
Agreed. Definitely.
Sorry, man, I went into a bit of a deep dive there, and
you did.
I have said the same thing to quite a few clients lately, so at least now I can just refer them to the podcast.
Nice one.
So next question, I have an investment property in Scarborough. It's a nice 3x2, 7 years old unit. Current tenants are leaving in 3 months and have been there for 2 years now. We found them through common friends, so did not use an agent. In this current market, would you get a real estate agent to find a new tenant? I'd like to save fees, but not sure how much work it is to find someone myself. Thank you in advance. I'm going to put this one to you. Right in your box.
Yep. Well, look, I'm going to front up by saying I'm biased, yeah. Of course, I work in property management. So for me, I would always say it's beneficial and it's better to pay for a good property manager. Not any old property manager, not a real estate agent. Potentially, it can be a waste of money. But a good property manager, worth the weight in gold. And a couple of reasons for that. I think no stress, right? A good manager takes that away. No emotional connection to the tenant. So, you don't know the person anyhow. Just leave it that way. That way you don't make decisions that are clouded by your emotion. Oh, poor tenant XYZ or whatever it might be. We try and stay away from that and make business decisions.
We'll let them catch up on their rent over the next 3 months. Before you know it, you're 3 months behind in rent and, it's not getting caught up. Or, you excuse them on that rental increase because you get too emotionally attached to their world. All of a sudden, you wake up 3 years later, the market's, you're under rented by $150 a week and you didn't even know it. And, that you can't get back that return that you could have had. So, yeah, it's hard when you're emotionally connected and tied into the tenant. Before I started this agency, I got so fed up with property managers that for a while, was managing my own properties, and it gave me a whole bunch of other challenges directly related to that I never experienced. And so that's why my team manage my properties, and thankfully I don't get directly involved in them.
Yeah, that's spot on. The last thing is obviously the fees are a tax deduction as well. So that's more little benefit on the side. But, back to the question, finding a tenant isn't hard.
Yeah, it's not just the tenant, finding the tenant at the start. And there is a bit more involved in it in the moment. Like, I think part of the problem is people think, oh yeah, it's fabulous getting 20 applications. But the trouble is when you actually go deeper and you know what you're looking for and you spend the time to screen these applications with the, incredibly deep, and then you're really only ending up probably with 1 to 2 quality tenants at the moment, because there is a lot of fringe tenants that don't have rental histories, that don't yet have jobs and they're applying before they get here. There's a lot of tenants that have got black marks when you look deeper that are struggling to sort of get something because of that. So,
well, precisely. And that's where I guess it's, like I said, finding a tenant isn't hard, but finding a good one is. Professionals are looking for, that's what they work their 9 to 5 jobs to do, rather than doing it around your job. You've got someone dedicated in doing that for you. The other thing that I would also mention is that the paperwork is very, very time consuming, and, the different...
We do it properly anyway, and actually, the team spend 3 or 4 hours creating a property condition report. There's hundreds of photos in there.
And this is where I see a lot of issues come up for self-managing landlords. They use the Form 1AA, the lease agreement that the department provides, and tenant sign it. It looks okay, right? But for example, our lease has an extra 27 special conditions that are added to bolster the conditions that are already there, and to really set that black and white about where the responsibility lies for different people and what we expect from tenants and what happens in a lease break situation, and a lot of that doesn't. Well, I know for sure none of that is done. They literally sign part A and B and that's it. So, the lease in itself, lodging the bond may not be too difficult, but it's another thing you need to do. And like you mentioned, the PCR, I get a lot of property condition reports from self-managing landlords. One particular one was, I'd say 40 weeks behind in rent, emotionally attached to the tenant, and asked if he had a PCR. And he said he did. So I had a look and tick box, tick, 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 tick. No description, no nothing, no photos. And it's very difficult to then be able to hold tenants accountable when you don't have proper evidence, photos, proof. And that's why I would suggest that, getting that paperwork done correctly on the upfront will save you headaches moving forward throughout the next year, 2, 5, 10 years of tenancy.
Yeah. And I guess it's about preventing small issues becoming bigger ones as the tenancy goes. Because, when you've got a quality tenant, that's half the battle. And when everything's right in their world, well, things are smooth sailing. But, they might lose their job. Their son might get addicted to drugs and bring trouble home. The stuff can happen. People can have other things going on in their world that turn their world upside down. And then you've just got to be really on the ball to prevent those smaller issues becoming bigger ones. And the trouble is that if you think, oh, well, I'll go get a property manager if I run into trouble. Well, a lot of property managers don't really want to come in and solve big messes. And so that can also make it hard, especially when you haven't set everything up the right way for the manager to be able to step in and hold that tenant fully accountable.
Yeah, no, spot on.
Great. Well, thanks for tackling that one, Dwayne. Next question. What do we got? You want to read this one?
Oh, it's a long one. But yeah, sure. I'm looking at buying my first investment property in Perth and intend to grow a portfolio after. I went there in 2019 and totally love this place. Sydney. I live in Sydney and can't travel to Perth to do inspections regularly. Would you please advise what approaches I should take to invest interstate? For example, should I use a buyer's agent? And if so, who would you recommend? Also, please recommend some suburbs for a max budget of $700K, house preferred, and within 30 kilometres drive from Perth CBD.
No worries. Well, again, we're of course got some bias when it comes to whether or not to use a buyer's agency, because we have been providing that service for the last year and getting some really great purchases for people. But of course, we've got a lot of clients that come to us for property management that don't use us for buyer's agency. So, we know what they go through with their experience as well, and see the sort of properties that they buy versus what we're buying and helping clients with. And it is really hard to do it from afar. Well, not impossible. If we've got a number of sort of do-it-yourself services, do you want to take us through those, Dwayne, and how we can potentially help, even though it's not the main thing that we do? there is some support that we can offer.
Yeah, so our investor support services include a few things. The first is a rental assessment, which I'm happy to provide to any client. So they've got an idea of the yield that they're looking at. And if there's any major red flags from the perspective of rental that I can see from the photos, I'm happy to do those at no cost within reason for prospective clients and provide them that feedback. So that's sort of number one.
And it's usually if you're serious enough on the property, we're not sending out 50 rental assessments for every single property you've seen on realestate.com while you're up until 2 a.m. the night before. So
once you've done your due diligence to a point you're comfortable, then you get me to my eyes over it, right? Number two, the next part of what we can do is an inspection, right? So we can actually go out and do the pre-purchase inspection for people looking at purchasing. It is a little bit tight at the moment with selling agents, I guess, with time. They've got a lot of offers, a lot of people. They don't really want to bend over backwards and fit you in, but ideally we're trying to get in there before the weekend, get the offers accepted for you before the weekend as well, right? So we'll go through and be able to accommodate that, do those pre-purchase inspections and provide you with a report for you to make some decisions on whether or not you wish to purchase the property.
And look, it's not the primary thing that we do, and the team are all very busy, and we've got to sort of prioritize our existing other clients and our other services. And a lot of the team don't work weekends. If I made all my property managers work the weekends, they wouldn't be sticking with us and they'd be getting burnt out as well. So it's a balancing act, and we sometimes don't have availability. And how a lot of clients get around that is that they might get a walkthrough video and a floor plan if possible from the selling agent, and then they could include a clause, subject to satisfaction of viewing within 48 hours or within 3 or 4 days. You just have to find out from the selling agent whether that's going to hurt your offer or not. And yes, it could hurt your offer at the moment in this market. But a lot of clients get us involved at the final inspection stage, especially Dwayne, don't they?
Yeah, precisely. So that's the other part of things we do for the inspection side of things. We'll go through and do the final inspection, checking out gas, plumbing and electrical, and making sure the property is still in good nick before the clients say yes and proceed with settlement. Okay, so that's usually done within the last week leading up to settlement, and we'll get out there and do that. Now, usually we do those for our clients, all the cost of $110 to that as well.
And this can often coincide with if you've appointed us as your property manager and you've included conditions to advertise the property and show it for rent, then we can usually be getting on to the marketing and having a tenant lined up, going in close to settlement. And, the other way that you can make sure you're getting what you pay for, of course, is including clauses for building and pest inspections to be carried out. And in this market, it's pretty hard to ask for anything more than what the REWA's standard annexures. And the standard annexures cover major structural defects, and they cover pest activity and pest damage. And you can usually get in your contract a warranty that all electrical, plumbing and gas items are in working order. And those things don't usually hurt your offer, and most offers would include those things in them. But the things outside of that are other maintenance that can be required. Sometimes it can be quite costly. Usually you can identify all of that in a walkthrough video. And if usually those are the things that we're looking for when we go through and inspect the property. And look, it's probably not going to change your purchase decision. It's more just a case of every property that you buy is going to have some level of maintenance. And it's a case of identifying that maintenance with the building inspection, identifying it when we do our final inspection, and then putting a bit of a plan in place for the next, 6 months, 2 years, 5 years, 10 years as to what are the things that are going to need doing on the property. And when we purchase a property for a client with our buyer's agency, we're looking to identify all of that up front and let them know when we do the final inspection and pass it over to our property management team to sort of implement that moving forward. And of course, some of the bigger reasons that you may look to use a buyer's agent is, I think where we add the most value is an evidence-based approach for suburb selection, and making the right choice of where you're buying can be the difference of getting much get a better growth over the short term and the long term, we well and truly pay for ourselves, with that expertise that we add to the mix of choosing the right property. And we have something called our trifecta criteria, which I've probably mentioned and you've heard me mention in previous podcasts, where we're analysing at the suburb level, the area level and the property level, is there any major deal breakers or red flags in here that are going to hurt its rentability, which Dwayne, has really great perspective on, and its resale, which I have great perspective on as well. So, we don't want to accept a shower that is half the normal width that no one can fit in when it's a single bathroom property, because yes, you'll find tenants for it now, but come a softer market, no tenant would want to rent a property like that. And that can be very costly to fix a shower when there's all existing built out walls, and it's not an easy one to solve. So it's a case of knowing, what trade-offs are okay to make and what ones you shouldn't. Because if you had an unlimited budget, you could have a perfect property with no trade-offs. But the moment you impose a budget, we're going to have to look at what are the appropriate things to trade off and what shouldn't you. And that's a lot of the expertise that we can add in the buyer's agency side. Suburb selection. Then when it comes to negotiation, well, how many properties have you bought before? How good are you at competing against a horde of hungry other buyers? Are you going to be able to build that rapport with the agent? And in many cases, I've known some of these agents for 10, 15 years. We catch up on if we've been fishing on the weekend, and I update, we're having a good chat for half an hour. And of course, they're more likely to then tell us what sort of price we need to pay to secure it over the other buyers. And we can work out whether that's too much to pay or whether it's an appropriate price. And part of using us is having the confidence to pull the trigger quickly, because you have to make quick decisions. I had the case on Monday with one of our buyer's agent clients. They didn't get back to us that day and the property's gone. And obviously I was a bit upset because I'd prepared all the research and everything for a decision, and they went off the map and had some busyness at work and whatnot. But that's how quickly you do need to make decisions at the moment, or you miss out.
I think the sales agents obviously are dealing with a lot of investors too. And to them, it's sort of like, come to the weekend, whatever. But when you've had that relationship with that sales agent for many, many years, and they see Jared's calling or Dwayne's calling, they'll actually talk to you and give you the time, and you can find out a lot more information from them too. So that the buyer's agents is, those relationships are what you're getting as part of that. And I think that makes a big difference to, as you said, finding out that pricing, finding out, what we need to offer, and, potentially being able to secure properties quickly as well.
And of course, the other thing that we can really help benefit clients is that we are getting access to quite a number of off-market properties. Like, there's a number of reasons that a seller would sell off-market. They could be under-rented or really poorly presented with trouble with their tenants, and our team can roll up their sleeves and try to solve that. And if you can pick it up for a decent or a price that's under market, it can be worth solving a tenant problem and purchasing it. It could be that the owners want to rent back or a delayed settlement, and so they're looking for a specific type of buyer, or they might not even be ready and on the market yet. So if you can speak to agents and get access to stuff that's off market and coming up, but provide that solution, it can certainly help. And we've also been cultivating a network of buyers agents that all use us for property management. And when we come across a property that suits, but we don't have a client for, we share it among our network, and that's where we're getting access to a lot of other properties that aren't yet on the market. So that's pretty much a quick summary. Was it quick? I got a little carried away. I'm not sure.
I don't think it was quick, but I think it was detailed. I think I'll just cover one last thing on that question. So the question did ask for some recommended suburbs with a max budget of 7. And I just want to refer this one back to how we can help our investors, right? So in the investor support service side of things, we do offer a buyer's information pack at a cost of $220, and it will give you 5 suburbs within your budget range that has had some great growth. And Jared, I think you can probably better explain the data crunching that's gone into how it's selected those suburbs.
Well, it's certainly not, just had great growth. Like we're looking at the historical performance of the suburb, and that, gets us a bit of a short list. And then we're overlaying the short-term prediction tools and other local knowledge that we have to bring that list down to the suburbs that have the best growth potential in the short term and the long term. So it's the methodology that we use for our buyer's agency that we also provide in our suburb selection for our buyer's information pack. We don't go anywhere near as deep as we would for our buyer's agency, but it's certainly going to be a much better starting point and a really good way for you to filter down your search, as opposed to anything that you might be doing with throwing darts at a board or buying in a suburb because your mate told you, or reading in the online forums how great Baldivis is and buying there.
No one does that, do they?
No. Right, next question. Hello, everyone. I have a question if anyone can give me some advice. Oh, yep, that's why I'm reading it. My parents live in a home at the moment and they have $250,000 on their mortgage left. And we've got a realtor to come and refinance the house. And they said the house was worth $1.4 million. Presume he's talking about we got an appraisal perhaps from an agent and then maybe a finance broker to potentially look at refinancing. We're thinking of using the equity to buy an investment property and we're told we could get about $600,000. Is this a good idea with the current market and interest rate situation? In all honesty, my parents are just able to pay the mortgage at the moment and me and my sister are planning to chip in if we do this. They said if the mortgage on the current home would increase, possibly to double, me and my sister are happy to contribute the investment we're planning to get rented. Well, that's a good start. Thanks everyone for the advice. Now, this brings me back to when I've listened to Robert Kiyosaki's audio book, and I'm pretty sure it's in Rich Dad's Guide to Investing, where he was telling the story that he was on a radio show and someone was calling up and saying, I can get access. My mum's prepared to give me access to her equity in her house, and what should I do to invest that? It really does come back to getting educated first, because my parents helped me out when I was starting, but I did learn enough to have a very clear plan what we were going to do with the property, what the time period was going to be, what sort of returns I was trying to achieve, what's the holding costs for the property going to be, who's going to pay what, and what are we going to do if my parents need the equity back? What are we going to do if I want to then go and buy a house or rent a house and can't continue to afford paying this shortfall? That arrangement might work for the shorter term, but, when you start getting a partner and a place of your own and wanting to do your own investing, does it still make sense for you to keep contributing over here if your partner's like, what about our own investing, or what's going on over here? And how are you going to split and share profits? It's likely to have to be in the parents' name, so they're going to have all the risk associated and tied up against their home. Like, do you really appreciate the position that you're potentially putting them in when they are probably towards the retiring stage of their investing? So, it's fabulous that they're prepared to look at helping you. I'm just trying to ask a lot of those extra questions for you to get super clear on the plan, the property, and how it's all going to work, and the worst case scenarios. Is there anything else there, Dwayne? Because I really did dive into that one.
You did. All those questions are very valid. And I think, for me, the first thing that jumps at me, there's a lot there. There's a lot of complexity, and two things really. One, work out an exit strategy. As you said, there's a different, multitude of things that might happen. So what happens if you lose your job, or your sister does, or who knows, and you need to speak those things out, put it in a plan, put it in writing, and everyone needs to agree on that moving forward before you even start. Secondarily, to me, whether this action is a good action to take is whether or not it fits into your overall plan for your investing and your sister's investing and your parents. So you're actually tying in three different, I guess, arguably entities or three different people's plans and trying to, use one course of action to fulfill three people's plans. Now, if you don't have a plan, then it's hard to say if this action is the right one to take to help you achieve where you want to be, right? So, I mean, to me, it's great that there is that equity. You've got that money that you're able to borrow, and your parents are fantastic for allowing that, but everyone needs to be clear on where they want to be by when, and then see does this action fit with everyone? Because if it doesn't, probably not the right course.
The other sort of way I see it structured a lot is if sister and brother have serviceability and they have jobs and they can actually borrow in their own right, what they're usually lacking is a deposit. So that it's not a bad way then if the parents can provide that deposit and they'd effectively be taking out a second loan against their house. But if the parents can only afford their current mortgage, I'm a bit worried about them getting any extra lending and qualifying for the banks in general. So that's going to be a potentially large roadblock. And all of this may not even be possible if you can't get over that first roadblock of, ticking the bank's box for serviceability. Someone has to service this, and then the deposit has to come from somewhere. And if you can't get an extra loan in the parent's name, then you're not going to be getting any equity out at all. So definitely go deeper with finance broker. Definitely think more about your plan and just jot down, some of the answers to those questions that we were posing. And in general, yes, it's a good time to look at buying property in Perth because there's more upside ahead and you will benefit, and it could set you both, you all up for, future having more choices. But you also don't want to have the wrong setup and the wrong property and have everything, restricting you all moving forward. And we don't want it to be your first experience in property to be a nightmare either. Next question. What are the hidden costs of property investing, the costs you don't normally think of when you first run your figures? And about what percentage of rental yield will have you close to break even or, dare I dream, positively geared for property, assuming you have borrowed the maximum amount a bank will allow you to secure the initial purchase? So I just thought I'd brainstorm on this one, Dwayne, because it's hard to know when we say hidden costs, it's hard to know what costs someone is aware of already. So it's probably worth just, rattling off all the things that we think of, both at the initial purchase and then maybe ongoingly. What are some of the initial purchase costs?
I think everyone knows about stamp duty.
Oh, yes, well, you have to factor that in.
But I mean, if you're looking at it from the point of rental, I mean, council rates, water rates, your insurances, landlord, building insurances. I think the one that arguably is hidden, and even some investors don't see it after investing for many years, is the cost of wear and tear that can happen on your property. And people don't factor in that replacement cost. So I come across this a lot. Carpets, say ATO depreciation lifespan is 8 years to 10 years. And if a property has the carpets for 40 years, there's a bit of saving there. But the other side is if tenants are wearing that out every 6 years or 7 years, there is a hidden cost of that replacement of carpet more frequently over time, right? And that's just an example of carpet, but it happens with all your appliances to the home as well. So one of the hidden costs that I find that people are not aware of is maintenance, right? Property managers not being on top of things and the maintenance bill building up. And you think, it's just the normal cost of running, an investment property, when in reality it might not be, and you can keep that investment cost down by minimizing that maintenance cost. So I think that's the first thing that jumps at me when I talk about hidden costs. But yeah, look, I don't even know where to start because there's so many. It's not arguably that people need to worry on.
I mean, people also have, out on the front end, they have their building and pest inspection, typically, $600 to $800. They have their settlement agent, which is probably around $800 to $1,000. They have a whole bunch of sort of smaller incidental costs with the loan setup and whatnot. So I usually say allow 5 to 6% of the purchase price in the upfront, setup cost. Go 6% just to be, safe. and have that extra money there if you need it. And then depending on that, how could someone really get a feel for their maintenance cost per year? It's probably going to depend on, age of the property, how well maintained it's going to be. And I sort of in my head allow for, up to 10 grand of stuff that I'm going to have to do in the first year. Like even a house that appears to be well maintained on the surface and it might pass the working electrical, plumbing and gas items all working at settlement. Inevitably, first year, on virtually every property I've purchased, it's like, oh, the air conditioner's stopped working, Jared. Oh, the rain should have stopped. Oh, did you realise, Jared, the oven needs replacing? These things are working at the time that we settle them, but ongoingly, you can expect at least, I think, allow 5 to 10 grand per year, minimum 5 grand. Just to keep your properties maintained. And it's obviously going to depend on how new it is. If it's obviously just been built, then you're going to have a bit of a honeymoon period where a lot of things might still be covered under warranty too. You're not going to have to do much at all. But then when we're talking older properties, and I get into a lot of the character homes and the properties with development potential and stuff. So, these tend to, I'm happy if I go a week without hearing from my manager or at least go a month without hearing from them. I get excited. So, and answer the rest of this question, I thought we'd just tie it up in a bow because they say, oh, what sort of yield do you need to end up neutral to positive? Well, I tend to look at the rental yields in Perth at the moment, and we're at sort of 5.5%. If you're purchasing around the median house price of around 550-600K, you're going to get 5.5%. So let's take the yield at 5.5%. You're probably going to have at least 1% of your yield, possibly 1.5% of your yield taken up in all of these costs and property management and land tax, which are other costs we hadn't mentioned there. So let's take it at 1.5%. So your yield starts out at 5.5%, you end up at 4%, and the average loan, typical loan at the moment, is probably around 6.5%. So you got a 2.5% spread there that you're likely to have to come up with, and that is probably, likely to be before negative gearing, before you go and get your tax deductions for having a shortfall at the end of the financial year. So let's look, we're left with 2.5% when we apply some negative gearing. If you're, able to save 30 cents in the dollar, 2.5 reduced is gonna, what is that going to be, Dwayne? I'm just calculating that out.
Well, you rightly calculating there, mate?
Look, it's going to be about 1.75% then. So let's say your purchase price is 550K. You can do top level numbers. If we're paying 1.75% of 550, that's going to be $9,625 per year. So I worked that out quite quickly, but back of the envelope, you don't really need to go much deeper unless you're really coming down close to the bone on what your monthly savings and your yearly savings ability is. Did I speak over your head then, Dwayne, or can you translate that to simple talk?
No, I think you explained that quite well, actually, but maybe we'll get some feedback from the listeners in the moment.
And so take that figure, 9,600. We said you'd need a 5K but surplus for maintenance per year. So yeah, I'd say that you'd really need 15 odd K in surplus investable money per year to sustain this property through its ups and downs. And, that's what I would at least be looking at. Now, how do we define if that's sort of worth it? And at the moment, we're going to likely get a decent surge in growth. But over the longer term, it's going to more probably average out at about 5% for that type of property. So if you're getting 5% and it's costing you 1.75 or 2%, you're still going to be ahead in that 3% spread per year. And this is going to be compounding the price in the background, not getting taxed until when and if you sell. So, and over time, our rental prices are going to keep going up as well. You don't just look at what it is when you purchase it. I expect strong rental prices ahead. We're probably going to increase 10% at least over the next year, maybe more. So that yield's going to really improve, and that's going to decrease what you are going to need to pay to hold it very quickly. So when we can project forward and actually create a plan, we can see, is this affordable now? How's it going to likely change over time? And what does that mean for sort of building a whole portfolio and having enough assets to give you the compounding growth that you need to create that passive income by a certain age, or at least have, a decent amount of equity or a certain amount of equity by a certain age in order to have more choices too. So when you built up the equity, you can choose to sell part or all of your properties and pay down debt, increase the passive income that you're getting from the portfolio, or you could choose to sell all or part of the properties and convert into higher income producing assets such as index funds or commercial property. So all of this gives you choices, but I think a lot of people that sort of think, I want to set and forget. I hear this, I want to set and forget property that I don't have to, pay anything towards. I don't have to. When you're investing, you got to put something in order to get something out, and it can take some time before it becomes neutral to positive. And you got to look at the bigger picture of where you're trying to get to, and be prepared to invest to get there. Does all that make sense, Ryan?
Yeah, absolutely. Yes.
Now, is it possible to get higher rental yields than the 5.5% that we're talking about? Well, when you go down to the lower price points, you certainly might be able to achieve 6 or 6.5%, but it doesn't come without the trade-off on growth. So usually I find that the overall return ends up at 10 to 10.5%. So if you're increasing your rental yield to 6.5, you're probably going to get a 3 to 3.5% average capital growth rate. Yes, you might get a surge in growth over the coming year or two because, Perth's increasing and prices are going to raise all boats, including units and apartments it'll get to. But over the longer term, there's no cheating the realities of supply and demand and where returns are going to revert to. So you really do need to expect lower growth if you're getting higher yield. Now, are there some other strategies that people can employ to get a higher rental yield? Yes, but they also don't come without much greater hassle and much greater risk. And in my opinion, it doesn't suit the average investor that's trying to do things passively and have set and forget. So if you want, you can look at rooming houses, and you can look at Airbnb, and you can look at other ways to, furnished properties. But all of this has extra hassle, and you have to put a real price on your time as well. And the risk on some of these is that, yes, they work well when the market's super hot like now, but when the market cools and we don't, or if we have a pandemic and we don't have any visitors using Airbnb at all, and we have no workers in the CBD to rent a furnished apartment, these are the type of, when you're chasing that higher yield, it comes at a higher risk that people don't always perceive the other side of. So just be aware of that. Woo! We covered some ground there. So, final question. Would one rather spend extra few thousand to get an individual sewerage to the main green title requirement, or save the money and settle for a survey strata? So, just to clarify, a green title property has its own services and its own sewerage connection, and a survey strata property often shares those connections and the services, and so you have to spend a bit extra to meet the requirements to get a green title. this person's in the process of subdividing a one block into two, and it's located in Baldivis. Here it is again. For green title, I may have to pay another 10K to tap through sewerage from the rear to the main sewerage juncture, plumber charging 15K, whereas for Strata, I can settle it with just 5K. So 15K versus 5K, basically 10K extra to end up with the green title. Is there a preference for green title or Strata these days? The plan is to rent both out or sell one and keep the other for rental income. So it's usually, if you're spending an extra 10K on two lots, the way I think about it is we're basically spending 5K per lot to end up with a green title. And when we're talking about such small amounts, I don't see why you wouldn't go for a green title. There is still a perception difference between green title and Strata, and it matters probably more when, what's typical for an area. Most people buying in Baldivis are going to want their own green title. When you're in a western suburb or something like that, it also does matter a lot, but there can be a lot of sort of buyers that are willing to go the Strata option just to get into that suburb, and it can be a good foot in the door so that they're not as worried about it. And I think green title for the outer suburbs is, it's always going to be valued at more, isn't it? Whether you're outer suburbs or western suburbs. I'm surprised that the differential isn't greater and there's not other requirements to meet. But if it's that simple and you're going to get the extra value back in your end prices, I think.
Oh, look, I 100% agree. I think there's a stigma still around the word, strata. And there's nothing else that might be shared. There may be no common walls. There may be no strata insurance, but strata can still sound scary to certain people. So look, to that price difference, I tend to agree. I'd go down that green title route as well myself.
Awesome. Well, thank you for tackling all of our questions today, Dwayne. And sorry if I got a bit excited and dived into some of those in the deep end, but hopefully it all made sense and people got a lot of value out of it. And head over to our Facebook group to join in the combos and post your questions. Plenty of people there to help out, and I love doing a episode every month or so just to give you my take and may even get you back again, Dwayne.
Sounds like a plan. Thanks, Joe.
Thanks, mate. Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.